It's 4 p.m. here at DBS Asia Central. I'm Taimur Beg, Chief Economist at DBS Group Research, welcoming you to our May 2024 Macro Insights live stream. As you may tell, this is not a real studio. This is a virtual reality setup. We're trying out something new for this time. The issues are, of course, not new. They've been around with us for a while. And today's presentation's title, Higher for Longer, sort of gives you the sense of the theme that we're going to worry about for the rest of the year. So these are our slides. And I will begin by talking about where we stand in terms of the outline of the presentation, where we're going to go. There will be quite a few questions to go over, so I will try to leave about 10-15 minutes toward the end for Q&A. But before we go to all of that, QR code for you on the screen. As you can see, if you don't want to scan on the QR code, you can also use dbs.pigeonhole.at on your internet browser with the password macro May. Same thing. Some people can do the QR code when they're on a mobile screen. So either option that you can use, and don't worry about it if you're not writing it down right now. We will give you this information several more times going forward. All right, so let's go with the outline. The US inflation backdrop is, of course, the key issue for that higher for longer narrative. We need to get a sense of where we stand with respect to US inflation before we go into the rest of the discussion. We will then look at the US fiscal picture, followed by discussions around fixed income market implications, and for a broad set of asset classes from currency to equities to commodities, even Bitcoin, we're going to talk about the implications of that higher for longer narrative. We also have a subsection toward the end where we will talk about Singapore, which has been attracting very substantial inflows in the last few years, and how that is being managed in the context of the monetary policy constraints that are posed by the higher for longer narrative. So let's get going, starting with the inflation backdrop. As you can see on this chart that we have over here, that US GDP deflator-based inflation momentum, right? I'm not talking about just the year-on-year inflation here. What you're seeing in this chart is a 3-month over 3-month seasonally adjusted annualized rate of inflation. This is part of the GDP release that came out a few weeks ago for the first quarter of 2024. That's the final data point that we're seeing in this chart. And there you can see that there's been a bit of an uptick, a rather worrisome uptick from a rather long-term trend that we have had for a good year, 2 years. The issue is that the steady decline in inflation pressure that we saw through the course of late 2022 all the way through 2023, that's what basically opened up expectations of substantial rate cut in 2024. All that has been upended to some extent. I'm not going to be very alarmist and say that inflation is rising its ugly head and this is the beginning of a broad new upper movement of inflation. I'm not saying any of those things. All I'm saying is that the chart amply shows the source of concern for policymakers and markets, which is we had a nice steady line of bringing inflation down. And then in the January, February, March quarter, we saw that turning in the opposite direction. We will dissect this a little bit later. So what is driving this pickup in PCE, whether it is headline or core or even some super core measures, that's all coming a little later. But before we get there, consider this as a juxtaposition to the inflation PCE on a quarterly basis. This is a year-on-year chart of core PCE. The Fed basically talks about that in its communication. That's what it's looking at. That's what it wants to stabilize at 2%. So the red line is showing you that it's been coming down nicely over time, maybe sort of flattening out a bit, but not that clear in this picture in particular. But the black line is a source of concern. Why? Because it seems to have a good lead-lag relationship between the way core inflation behaves and slightly before that, the way this issue, which is ISM manufacturing price behaves. Now that, over the last 3 months, have gone sort of in the wrong direction, if you will. It's been picking up a bit. That certainly is a cause for concern. We have the data all the way through April, and that's telling us that if this lead-lag relationship persists, core inflation's downward trajectory may be over. And if it is getting stuck at slightly below 3 and not going anywhere toward 2.5, that I think becomes a very big source of concern and problem for the Fed, which I think we can all say quite safely is rather keen to implement some interest rates cuts. But this sort of development is somewhat problematic. Okay, so now let's try to sort of go slightly deeper into the drivers of inflation and what is causing this sort of stickiness, if you will, or some rebound on the inflation side. The story is not on goods inflation. As you can see on this chart, the red bar is what is the representation of goods inflation. Well, that has turned negative in the last 3 months. That is not the problem. The problem is the gray bar to some extent, the housing side of the inflation, but even that is not as big as it was, in 2023 when we had inflation in the 5 handle. At that time, the gray bar was very large. The issue is the third issue, the blue part, core services excluding housing. This is what's known as core inflation, if you will. So we're going to go there, and what we'll show you when we look at that core part of the inflation, services ex housing, is that it's healthcare, financial services. Those are the sources of headache. All right, so now let's take a deep dive there. So this is contribution to 12-month super core services PCE inflation. So that's a handful, but the bottom line is that we're not talking about the overall PCE inflation. We're talking about the core inflation, and even within the core inflation, we're talking at a subset, which is services ex housing. So that's a super core part of the issue, and that's where the picture really becomes clear as to what is driving this frustrating stickiness in inflation. It's that green bar that's become, kind of sticky. That's the other part of the thing. But beyond other, where are we seeing problems? Healthcare, the sort of orange-ish bar, and then financial services, which is the gray bar. Those are the areas where we have seen stickiness or incremental pickup in inflation. Talk to anybody, friends, relatives that you have in the United States. They will attest to what's happening to financial services, auto insurance, home insurance, healthcare insurance. Everywhere there has been substantial pickup in the last year or two, and that is showing no sign of abating whatsoever. And that's the sort of insurance rates, service charges, car repair costs, for example. Those things have caused this services part of inflation to become rather sticky. I'm going to share with you a quote from the ISM survey. So whenever there's an ISM survey, in addition to producing the diffusion index, which is how many of the survey respondents say inflation pressure is up, inflation pressure is down, how many of the survey respondents say manufacturing orders are picking up or not. Beyond that, there's also actual survey responses from certain businesses. And I found one rather striking. So what does this one say? We are still experiencing supply chain challenges with increased costs of raw material, particularly chemicals and their containers, as well as higher US and overseas freight transportation costs. A container shortage has increased costs and slowed down the supply chain. You would have thought by now these issues would be behind us, that the ports are operating pretty well, since goods inflation is down, the pass-through push that bedeviled producers 2-3 years ago, that would be all behind us. But clearly, this particular respondent is telling you that those supply chain normalizations have not been 100%. They're still a source of concern. They still make producers amenable to pushing some of those prices up because they're actually seeing higher costs. So this is the key source of headache for the Federal Reserve and the markets. That clean narrative of steady disinflation seems to have left behind in December of 2023. During January to April of this year, we're seeing stickiness, not from goods side, not even from housing, but rather from the core services part. What about Asia? We've so far talked about the inflation story in the US. And those of you who have attended our Macro Insights live stream before, you know that we use the exact same measure that the Fed uses, the 3-month over 3-month annualized rate of inflation, as a gauge for momentum. We applied that for Asia as well. So what we're seeing in this chart is all of Asian economies, GDP weighted, and their aggregate inflation measure, both headline, food, and core. So not a lot to worry about as far as core inflation is concerned. So that's where the story gets different. That core inflation in the US is still a source of worry. Core inflation in Asia is not a source of worry. But as far as food inflation is concerned, there is some worry that we've seen a bit of a bottoming out of some of the deflation that we saw in food late 2023. In the first few months, that has sort of turned around. But if we're talking about overall CPI and core inflation momentum, not particularly anything to worry about. Oil prices are well behaved. Food on the margin could be a concern, but beyond that, tradable goods, consumer goods seem to be in pretty good shape. So the issue of higher for longer is an entirely, right now, a US-centric issue. Some inflation pressure might pop up later in the year if commodity prices were to rebound, but that's a story that nobody can really have any very strong handle on. That depends on geopolitics, et cetera. But as of right now, Asia doesn't really have an inflation problem. The US does, but since the US monetary policy pulls the whole world's monetary policy around, US interest rates remaining sticky is a problem for Asia. So that's why inflation is not the only way to measure where monetary policy will be in Asia. You got to see inflation beyond Asia. You got to see what's happening with that in the US. Okay, so having said that, let's now talk about the US. Again, back to the US with respect to fiscal, because the US fiscal picture is probably the most critical one when we talk about complications associated with higher for longer. So what we have here is something that will give you a very good sense of where the fiscal outlays of the US are and where the negative and positive developments are happening. Now, we know that the US economy has been doing well and joblessness has fallen substantially, unemployment rate has fallen. So you can see by extension that claims on unemployment benefit would also be falling. And that's exactly what we see when we look at the US fiscal numbers on a 12-month change basis. Social Security related payments have actually fallen substantially, which is a good deal for the US fiscal. That reduces the deficit because it's a reduction in expenditure outlays. But as far as good news is concerned, that's about it. There's nothing else that is going in the right direction for US fiscal. Interest payments have ballooned. Can you imagine in the last 12 months? It's a delta, right? We're not talking about level. Increase in interest payment by the US government is $225 billion. They're heading toward $1 trillion of interest payment on their debt on an annual basis. That's the kind of situation we are in right now. And we might see it even go worse if indeed 10-year treasuries and 30-year treasuries hover around 4.7, 4.8. Fiscal stimulus-related support, housing credit, still substantially higher than it used to be. We've seen a big pickup in defense-related spending, about $50 billion. And Social Security payments have also gone up substantially. By the way, that's a structural development. America is aging. It's not taking on as many immigrants as it used to in the past. So that aging dynamic that really, really afflicts the Japanese economy, that is about to afflict the Chinese economy, don't think the US is immune from that as well. There is a silver wave there, and the pickup in Social Security payments attests to that. Now, should we worry? Should we worry if we have so many things in the red in the US? Well, there are other mitigating factors. First and foremost, just because the deficit has picked up doesn't necessarily mean that the US Treasury has to go out and issue lots of bonds. In our last measure, we see that the US Treasury has over $1 trillion of cash sitting with the Federal Reserve, so they can certainly run that down before they have to go issue bonds. But even that, when they do issue bonds, we see pretty decent demand for US Treasuries. US bonds are well bid. It's an interesting thing to say, given that a lot of times I hear from our clients that they are worried about not enough demand for US Treasuries, given some of the news that they read that the Chinese holding of US Treasuries have gone down by $200 billion. Even the Japanese, the perennial hoarder of US Treasuries, have seen a decline in their Treasury holdings. So when you take into account those sort of stories, you think, well, maybe there's not a lot of demand. But that's why we've decided to put these two bullets up on the screen, that as far as Asian central banks are concerned, they may have cut back on their bond demand. But when you look at central banks in Latin America, sovereign wealth funds in Latin America, and then also in the Middle East, substantial amount of surpluses there from commodity exports, and those are being deployed into buying some degree of US Treasury holdings, and therefore even official sector demand is not unmitigated negative. There is drag coming from China, Japan, but there is also offset happening from the Middle East and LATAM. Beyond that, the key issue is, of course, private sector demand. So as you can see in this chart, very clear that the gray line shows that public sector holding of US Treasuries have gone down. The sort of decline you see from Japan and China surely cannot be fully offset by everybody else buying, given that they're so large. What is really interesting is the private sector part. The blue line is showing that there is absolutely no relenting of demand coming from the private sector. Who in the private sector is buying these treasuries? Well, we see insurance companies, pension funds, asset managers, all with substantial asset liability matching requirement, particularly with respect to insurance companies, which a few years ago during ultra low interest rates were really struggling financially to meet their various commitments on pension and insurance payment. They certainly are now seeing their balance sheets improve in quality, and they're trying to match their duration risk with healthy yielding US Treasury assets, which have 10, 20, 30-year duration and will be paying positive in real terms. So in a world where there aren't that many alternatives to US Treasury, even the higher for longer narrative does not necessarily cast a doom spell on US ability to fund its budget deficit. There's substantial demand globally, increasingly from the private sector, but also some degree from the public sector to hold US Treasuries. So before we go into the other aspects of where this higher for longer narrative is, I just want to remind you that if you have questions on the parts that I just went over, the fiscal picture, the inflation picture, most welcome to send us questions. Scan the QR code or go to dbspigeonhole.at, and there's your password, macro May. And I'll be looking at those questions a little later and try to address as many of them as I can. All right, let's now move on to the third part of the presentation. What are the fixed income implications of the higher for longer narrative? So we start by looking at the steepening we've seen around the world in the last 3 months. It's not as acute as it was a few weeks ago. And I'll talk about how the markets have become volatile momentarily. But at least if you even see this picture, that over the last 3 months, we've seen a steepening of the US Treasury curve, for example, by 35 basis points. Sing dollar curve has steepened by 32 basis points, 33 basis points. Same with Taiwan dollar curve, Hong Kong dollar curve. The only curve that we can think of in the major markets that actually has flattened is the Japanese one, for reasons that we will talk about in great detail when we come to the FX section. Yen and yen-related story is a whole different ballgame that requires a little more time. But this tour of the world's yield curve tells you that there has been a big capitulation in the global fixed income market over the last 3 months. I would characterize this as a bull steepening, meaning the long end has gone up, not because of major doom and gloom worries, but because GDP growth, inflation, everything is seen at a higher light than people would have expected. Basic expectation for 2024 was both inflation and growth will slow. When you reverse those expectations, growth may not be coming down anytime soon, inflation may not go toward 2%, then you have a classic, what we call a bull steepening scenario. The market expects higher for longer, but for good reasons. Growth is strong, demand is pulling up inflation, so the Fed will not be able to cut a lot, therefore that expectation to show up in the long end of the Treasury curve. So the first fixed income implication is steepening, bull steepening. Now you don't want some sort of a bear steepening to happen tomorrow where short end absolutely collapses because the growth is slowing down. That again would be destabilizing for the market, and it will be a steepening around bad news. Right now what we have is rather sort of strong growth, strong price, demand, that sort of mix. So now based on that, where do we stand? Now, before talking about where we stand, let's also talk about where we used to stand 4 months ago. If the global fixed income markets have capitulated so much, surely we have also had to adjust our forecast. Lo and behold, that's the case. So let's start with the Fed funds rate. So this is where I saw that back in December 2023, when we wrote the 24 outlook, we thought that this year would be a year of 100 basis points of rate cuts. We didn't think it was going to be anytime soon. We kept it in the second half of 2024, but now it seems like that even is unlikely. I'll come to the revision in a second. Then, baked on the back of that, we also thought another 100 basis points of rate cut was in the picture for 2025. So Fed funds rate, in our view, was going to go through 200 basis points of cuts through 24-25. So we've scaled back some of those expectations. As you can see, May 2024, that's our latest forecast. Now we're seeing 50 basis points of rate cut in the second half of this year. That's about the most we can expect. And even that requires strong scrutiny. Let's keep an eye on the inflation data. But right now, we still think there is room for the Fed to cut at least twice in the second half of this year. On the back of that, we do think growth will be slowing in the latter part of this year, early 2025, paving the way for 4 more rate cuts by the Fed and taking the terminal Fed, or rather the end of 2025 Fed rates to 4%. Could it be higher? Of course it could be higher. Given the way inflation has panned out so far, if this trend were to continue for 3-4 months, it would be very hard for the Fed to cut this year. But don't count out that possibility. In our view, there's still substantial pipeline disinflation in the second quarter. It will come from rentals. It will come from more goods disinflation. Energy may be an offset, but on the services side, insurance rates, whether it's health or car, those things can keep on going up. Already there's a bit of a strong consumer revolt, and regulators also looking at those things. So I do think some of the core services inflation that has been a big source of stickiness will dissipate, and that would then start opening up some room for a rate cut. And along with that, just not the inflation story, if we see labor market beginning to weaken a tad, the Fed would be able to cut rates by 2 times in the second half of this year. We know that all of that can be totally out of the window if inflation doesn't ease up and stay firm. We know that. So based on that, what is Eugene Liao, our fixed income strategist, what's his fixed income forecast? So as you can see, at the end of 2023, that's the first row of that second box we have on the screen over there, Eugene was expecting end 2024 Fed funds rate to be up to 4.1%. So I guess that was in expectation of 100 basis points of decline in the short end interest rate. And then it was going to be about 4-ish at end 2025. So now that I have sort of scaled back my rate cut expectations, Eugene has scaled back some of the rate numbers that he's been looking at. So that's about 4.5 for end 2024. I think we're at about 4.7 right now. So some degree of rally is expected on the US fixed income side, and then remains more or less around 4.5 through 2025. I'm assuming this incorporates expectation of fiscal stress, political uncertainty, and no major structural reform in the US, keeping rates somewhat elevated, keeping supply of bonds somewhat elevated. Now, in terms of pricing, it's been really all over the place. I mean, think about it. The chart that I have on the screen right now is only 6 months worth of data. And in the 6 months worth of data, we have gone all over the place. By January of 2024, the market was expecting 175 basis points of rate cut in 2024. And on top of that, it was expecting additional rate cut in 2025. That's all gone out of the window. In fact, if we were having this live stream 2 weeks ago, we would have been talking about virtually no cuts being priced in 2024. As you can see over there, at some point last month, it went up to virtually nothing, like only about 25 basis points of rate cut. In fact, about a week ago, after the Fed meeting, I think the markets were basically ready to give up on rate cut possibilities for this year. Then came Friday's payrolls numbers. It was weaker than expected. And all of a sudden, everybody started thinking that maybe there will be incipient weakness in the economy, and that would lead to the Fed cutting rates. So at the end of last week, again, we saw expectations heading toward 2 rate cuts. And then in the last couple of days, we're talking to you on a Thursday. In the last few trading days in the US, again, we have seen some capitulation on the rate cut expectation. So we are all over the place. We have gone from expecting 7 rate cuts this year to no rate cuts, back to 1 or 2 rate cuts. I think this is a marker of things to come. Neither the Fed nor the fixed income market has a very good handle on where inflation is going. And therefore, to borrow that cliche, data dependency is all that there is. There is no forward guidance. There is no rules-based approach to monetary policy anymore. It's about next month's data on inflation, next month's data on industrial production and unemployment, and that's going to drive whether there's ability or amenability toward cutting rates in the second half of this year by 1 or 2 times. So this sort of volatility is not going to go away. Expect more zigzags. I will come back to you 1 month from now. I am pretty sure where this line is going to go up or down, well, that I can't tell, but there will be zigzags that I'm quite sure about. All right. The key issue is the absorption capacity of global markets and global economies with this higher for longer narrative. Mind you, at the beginning of this year, we were all expecting substantial rate cuts this year and next. We have given up on that expectation of substantial rate cuts already. All that's left to debate is, will there be any cuts at all this year, or will there be a nominal, couple of rate cuts this year? Either way, companies, countries with short duration risk, where they need to refinance their debt in a substantial manner, no relief for them at all. So this was the fear that we had when interest rates went up a lot in 2022, 2023, that we will find that there are a lot of sovereign economies, there are a lot of companies which have a mountain of debt that they need to refinance, and as interest rates get readjusted upward, they will struggle to pay back their loans, which will lead to credit costs going up, credit risk going up, economic slowdown happening. None of that has happened so far. It's pretty remarkable that other than some regional bank-related hiccups we saw about a year ago in the US, we really have seen no major financial stability issue manifest, despite the fact interest rates have gone up so much. For the rest of the year, if indeed interest rates remain pretty high, meaning 10-year at 4.5 and above, and the short-term rates remain at 5 and above, surely some companies, some sovereigns, which were at the precipice of struggle, will start struggling mightily. I'm waiting to see that. And I think that there is a very strong gravitational pull of higher for longer. There's a reason why rates don't remain very high for a very long time, because they start creating an implosion in the economy in terms of bankruptcies and loan delinquencies. I think that's coming. Maybe not so widespread to create a panic in the market, but I do think there is a set of companies, countries out there which will report significant struggles as the year progresses. It's true, so far it's been resilient, but just because it's been resilient so far does not guarantee sustained resiliency going forward. All right, enough about the fixed income market. Let's talk a little bit about what's happening in the currency market in the backdrop of all this. Some very interesting developments, right? If you are going to have US rates so deep into the cycle at such high levels, it's really sort of impossible to resist the US dollar. And that's what we have been seeing. So this is a picture of the DXY, as well as the red bar, which is showing to you what's happening with position taking as far as the US dollar is concerned. So below the 0 point on the red bar, we are sort of short dollar. Above, the market is net basis, long dollar. And a couple of takeaways. First of all, the market was pretty bearish the dollar till late last year. And then this stickiness of inflation has kind of overturned that narrative. And just like the rates curve became volatile, the currency market became volatile. And we have now seen a bit of a capitulation and a huge amount of net long positioning on the US dollar. I mean, we haven't seen anything like this till the early days of the pandemic. And even that was very short-lived. But we're in that sort of overall bullishness with respect to the US dollar is concerned. Now, the DXY has moved up, or rather has not gone the way it was expected to go. It was supposed to go down this year. What we've seen in the last couple of months is they sort of started to go up a little bit. And against that, a wide range of currencies have adjusted and weakened. What is interesting is all this is taking place at a time when there is genuine question about the valuation of the US dollar. There is genuine question of geopolitical risks associated with holding the dollar. Start with the issue of US dollar valuation. If you look at a straightforward economic analytical approach toward US current account and US fiscal account and the overall sort of dynamics of the US economy, you would probably argue that there's some argument to be made that US dollar is overvalued, that the current account deficit of the US needs to adjust on the back of weakening of the US dollar, or the overall sort of export dynamics of the US is being hampered by an excessively strong dollar, and that can only be addressed if the dollar were to weaken. Not really sure there are too many buyers of that argument, but that would be the straightforward economic way of looking at it. But then you could also argue that given what the US is doing with respect to protectionism, with respect to industrial policy, that there will actually be a forced amount of flow coming into the US. If you cannot sell to the US through trade route, you build in the US. And if the US is driving a lot of investment, that entails, again, a lot of demand for US dollars. And as a result, the dollar should be stronger. So I don't think there is a very clear-cut assessment of the US dollar. I'll show in the next slide that there are disagreements about that between reasonable people around the world who observe the dollar very, very closely. Now let's go to the second issue, the antipathy about the US dollar. Ever since the Taliban takeover of Afghanistan, when the US government seized Central Bank of Afghanistan's reserves, to Russia's invasion of Ukraine, when the Americans and the Europeans again seized Russian central bank's assets, there's been a sea change in the perception of how sticky your own assets are when you place them in foreign central banks or foreign banks, especially if it's US dollar. The US has certainly shown that it is willing to weaponize the US dollar for a variety of geopolitical factors. So for example, it doesn't allow North Korea or Iran to access the SWIFT network to settle trades. It is punishing companies that trade with Russia right now, and companies that sort of try to circumvent that are subject to a lot of sanctions. And central banks, including that of Russia and Afghanistan, have seen their assets frozen. This, of course, makes the rest of the world's central banks very, very nervous. You may be friendly with the US today, but would you be friends with the US next year if, say, Donald Trump were to become president? You may have a lot of US dollar assets, but what if when you really need them because of geopolitical tension is precisely when the US freezes your access to that? So that sort of concern has manifested in quite a bit of gold buying, but the central bank and sovereign fund level in the past year or two. So you have these interesting developments with respect to people not wanting to hold a lot of US dollar, juxtaposed with the fact that the US dollar is facing relentless appreciation pressure because of the higher for longer narrative. Currency vols are not particularly high. I mean, they were much, much higher during the bad old days of 2022, 2023. But they have not been crushed entirely. Over the last couple of months, we have begun to see currency vols go up. And returns of global currencies against the US dollar, well, by and large negative. US has rallied over everything else. Whether you are looking at DM currencies, that's the black line, or you're looking at the emerging market currencies, that's the red line over there, both are now down about 10, 12% against the US, set against the base of January 2022. So currency markets may not be particularly volatile around the higher for longer narrative, but it's certainly creating losses for just about every single currency out there other than the US dollar. Now, the other area, and I alluded to this, that I was going to talk about it in the currency space, is the Japanese yen. Very interesting developments there. What is happening to Japan? They have been fighting to end inflation for a long time. Looks like they've kind of succeeded. But then there are all these other things that are happening that create a rather complex economic picture. Let's look at them one by one. I've got three charts on the screen right here. As you can see, the first one is the movement of both the nominal and the real effective exchange rate of the Japanese currency. And they have been correcting relentlessly for about a decade. So a decade of currency depreciation. Expectation was, of course, that this would feed into inflation, which is what Japan was trying to achieve when it had chronic deflation problem. Well, they have succeeded, no question about that. And what did they get? They got some inflation. Not a lot of inflation, some inflation. So at one point, headline CPI, core CPI have gone over 4%, but temporarily. As you can see from the latest data, actually inflation has come down quite a bit. So in terms of cost of weak yen, that somehow Japan, because it's a big importer of energy, that weak yen would cause a significant amount of imported inflation. The data really doesn't show that well, does it? It's got positive inflation, but not necessarily galloping inflation by any means whatsoever. Now, the people who are really enjoying the weak yen are the Japanese exporters. If you look at the black line on the screen here, the third chart over there, it shows that in US dollar terms, the exports are flattish. They were up a little bit, then they've come down a bit, not particularly exciting. But you convert those dollar earnings into yen earnings, it's up about 10% or more. So this is where the biggest benefit of the weak yen has been, and this is why you don't hear Japanese industrialists, going to complain about the weakening of the yen, that somehow that is creating problems of importing goods for their production that is costing. No, they're happy about the fact that they're making a lot of money in yen terms by exporting their products. So a little more on Japan. One problem with inflation is wages. That if your nominal wage growth is lagging inflation, then your real purchasing capacity is waning. And as you can see in this picture over here, that real wage growth has been on the negative side in Japan. I'm not going to worry too much about this issue. Understanding right now that we hear from Japanese press is that this year's wage negotiations between Japanese workers and unions and the companies is going to yield to a pretty decent pickup in nominal wages. So I, again, don't think that real wages being negative is a major source of consternation for the Bank of Japan or the Ministry of Finance in Japan, that they would want to strengthen the yen just because of that. these are issues, but I would argue these are sort of marginal issues. Now, the second box over here, that's an issue. That is something which you have to remarkable that we're looking at a decade-long picture, and during this entire phase, the Bank of Japan, the cabinet of Japan has never been this unpopular. You could argue it's because of inflation. You could argue it's because of the quality of leadership, or maybe people's sort of discontent with the way the Japanese economy has been going. But by and large, the government of Kishida has not been having a great time. They're very unpopular. So to turn the popularity around, is there some argument to be made on appreciating the yen? So there are bits and pieces you could argue that the yen is not particularly helpful. Real wages, popularity ranking, perhaps. But I don't think these are the key issues. The key issues are that final box over there. The 2 points I have on the box, that's the key issue. That the Americans, as well as a bunch of other countries, are pointing out repeatedly that this kind of currency market volatility, with the yen going from 140 to 50 to 55 and perhaps even beyond, this is a problem. Because it's not Japan in isolation, it's the rest of the world. If the yen keeps on weakening, it'll have contagion on other currencies, including the won and maybe other third market competitors. And those countries may have a whole different set of inflation fighting dynamic than what the Bank of Japan has. They might have a greater degree of urgency. And we also have the counterpart of the weakening of the yen is the appreciation of the US dollar. Now, I was in Washington, D.C. 2 weeks ago, met a lot of people on the US government side, in the IMF, elsewhere, and I heard a very interesting and contrasting view on the US dollar, especially with respect to the yen. The American officials don't like it. They think that the US dollar is overvalued. They think the yen's depreciation is well beyond any reasonable sort of depreciation one can expect, that the BOJ should normalize policy, raise interest rates, and get Japan back onto a normal footing. In fact, the Americans convinced the Japanese and the Koreans back in April 17 in their trilateral ministerial statement to talk about the currency depreciation's undesirability at the very first paragraph of that communique, which I think is kind of remarkable. Whether the IMF and other multilateral organizations whose job is to look at currency valuation agree with that or not is a different story. But clearly, the Americans pressuring the Japanese with the specter of Trump may or may not be coming late this year, I think that would be the issue that makes the Japanese authorities somewhat on tenterhooks about what to do with their currency. All right. Again, reminder, QR code you can scan, or you can go to dbs.pigeonhole.at with the password macro-May. That will take you to the Q&A session. Send me questions. I will get to them in about 10 minutes' time. All right, what's happening to other assets? And we're going to do a quick roundup of equities, energy, gold, and crypto. So let's start with equities. S&P 500 vols are not an issue. It's not worrying anybody at all. We've seen some worries about the earnings season marginally here and there. Whenever we hear the higher for longer narrative setting in, it creates some worry in the markets, but it doesn't seem to be two-way worry that one day we're very bullish, next day we're very bearish. It's been actually far less volatile than the fixed income market. Normally, fixed income market is supposed to be the smart money, but I think the equity market has been actually far smarter and calmer with respect to the gyration of inflation expectation, and they have kept on bidding up S&P prices on a fairly relentless basis. Okay, little bit of a wobble, and perhaps you could argue that the last couple of months you don't have the same kind of exuberance that the U.S. market had, but that is coming on the back of a very, very strong rally. I mean, just look at the movement of the U.S. S&P 500 from late 23 to now. So some breather is expected. Valuation-wise, yeah, it's been eye-watering. U.S. Long-term PE, basically based on sort of 10 years worth of earnings relative to price, that is some of the most expensive that we have seen in history. Even before the 07 crisis, we didn't have such high long-term PE. At some point in 21, they were very high, but since then they came down, but now they're back up again. So U.S. equity markets are shrugging off the higher for longer narrative and bidding up prices in a pretty vigorous manner. Whether it's sustainable or not is a whole different ballgame. I worry about the sustainability of the U.S. markets, especially when I look at what is known as a yield gap. Right now, the difference between S&P 500 dividend yield and 10-year Treasury is about 3%. That is a lot. Normally, you don't see the equity market do well at times like that. But there are other things to look at beyond the equity markets in terms of valuation. Consider commodities. If the global growth backdrop is decent and there's not a lot of concern about the high interest rates hurting, we should see commodities begin to chug along, right? But that's not the case at all. Look at the red line over here. Commodities have come down a lot. So this really has flown in the face of the doomsayers that around the geopolitical uncertainty with the Middle East and the Ukraine, we're going to see a big commodity super cycle. So far, not at all. The high rates are doing exactly what they should be doing to commodities. They're not hurting equities for a variety of reasons. Maybe there's a big cycle around AI and tech companies' earnings are helping the equity market stay strong. But on the commodity side, no such support. The moment we've seen high real interest rates, which is what you were seeing here, we've got a 10-year Treasury chart. Earlier you saw real rates in the 2.5% handle. Around that, commodities have shown quite a bit of sign of weakness. Which commodity is weak and which commodity is not so weak? Well, let's take a little broader dive into it. So we've got a time series of 5 key commodities: crude oil, soybean, copper, gold, and wheat. And what we're going to see is that there are a couple of commodities which are very much in the negative territory, wheat and soybean in particular. Good news that although you saw earlier food inflation momentum in Asia begin to pick up, worldwide, it's not a problem. Down good 10% or not down 25% as they were at some point last year, but still negative impulse as far as global inflation is concerned. But beyond that, some interesting developments, right? Gold, I'll talk about gold more detail a little later, but is up substantially, about 20% on a year-on-year basis. And oil has begun to pick up. I don't think the level of oil at $70, $80 is particularly worrisome, but on a year-on-year basis, if they're up, they start contributing to inflation. So that's one thing to keep an eye on. And then this blue dotted line that I have over here, which is copper, is the interesting one. I think that's a very good proxy for not just global demand, but demand from China, which is the industrial hub of the world. And there, again, we're seeing on the margin a little bit of perking up. But overall, commodity prices, particularly food prices, are down substantially on a year-on-year basis. All right, next is gold. Gold should not be where it is at all. Given the historical relationship between U.S. real interest rates and gold, at least going by the chart, should be around $1,300 or $1,400. Where is it now? It's $2,300, about $1,000 more than what would the historical relationship suggest. Now, why is that big divergence? Well, the short answer, geopolitics. As I said earlier, when we were talking in the context of the dollar, that the weaponization of the US dollar has made some countries and some companies and some state-owned organizations a bit reluctant to hold a lot of dollar, and hence they're hedging it by not holding as many treasuries, for example. Well, what are they buying instead? They're buying gold. You see this among sovereign wealth funds in the Middle East. You see this among the Chinese. You see this very much by the Russians, who really don't want to hold dollar assets anymore. So that has all supported gold demand and pushed up gold prices substantially. And by and large, it reflects the nervousness associated with higher for longer in a world where there are also a bunch of wars going on. That's why people want to hedge. Normally, at such high yield, a zero yielding asset like gold should be collapsing in price, but it's actually holding its value substantially. And it's not just gold. Think about cryptos, right? Bitcoin sort of come back from the dead and has done extremely well, including a bunch of other cryptocurrencies. So when we look at this first chart over here, the market capitalization of Ether and Bitcoin, they've spiked along with their prices in a very big way. Big development this year, of course, has been SEC's clearance of ETFs to be built around cryptos. As you can see in the green bar in the line, the chart over there, there's substantial inflow into the crypto asset world in the first 2-3 months of this year. It sort of died down a bit, and along with that, Bitcoin has corrected a bit. There's also some other expectation of the Bitcoin halving that should also have some galvanizing impact. But by and large, we saw substantial position taking on crypto earlier this year. And I don't think it's just related to ETFs and halving of Bitcoin. It's got to do with the same reason why people want to hold gold. There is some uncertainty and discomfort with this relentless rise of the dollar and the weaponization of the US dollar. All right, Final part of my presentation, the Singapore angle. So I highly recommend those of you who are interested to read this piece by our Singapore economist, Hunting Chua, which came out yesterday. If you just Google it, you'll see it. It's called The Role of Foreign Capital Inflows in Singapore. And the article has a couple of compelling charts, and I want to share them with you before I go into the question and answer part of this presentation. Singapore has received an extraordinary amount of inflows in recent years. I don't think it is very well appreciated or understood inside or outside of Singapore, the kind of flows that has come into this country in the last 4 or 5 years. Just consider the first chart over here. The gray bars are aligned with the left side of the scale, and the red line is aligned with the right side of the scale. Red bar is percentage of GDP, and the red line, percent of GDP, and the gray bars are actual dollars. Every single year in the last 5 years, Singapore has received between $200 to $300 billion in inflows. We're talking about close to $1 trillion of money that has come into this tiny island in the last 5 years. It's hard to manage so much money. And as a share of GDP, we're talking about, again, 50, 60%, 40% of GDP in Singapore coming in year by year. Managing that is a Herculean task. Just about any country would be overwhelmed by that. Now, one good thing is that this is not all hot money. The second chart that you see in this panel tells you that there's actually a substantial amount of foreign direct investment coming into Singapore. That's the red dotted bar. In fact, among the key Asian economies, which are now capturing a lot of global interest, global investor interest, people want to build fabs in Korea. They want to take EV plants in ASEAN 5. Those countries are not doing that well, and definitely not China, which is hardly getting any inflows. Singapore is leaving all those countries into the dust in terms of attracting global FDI. As you can see, the last data point here is fourth quarter of 2023. In the second chart, close to $60 billion of investment coming into Singapore. So substantial inflows, which then creates certain policy headaches. So let's look at that. How do you manage all those dollars coming to the economy? You can intervene and buy up those dollars. Then your reserve is built up. And then whatever Sing dollar you issued to buy up those dollars, you issue bonds to sterilize that, which is your classic sterilized intervention by a central bank. So looking at the monetary aggregates of Singapore, which is the first chart in this panel, not bad, MAS. Monetary growth, M2 to GDP has been fairly stable. M2 growth is 4 or 5%. Doesn't look like something that is unmanageable. You could argue that in 2020, around the pandemic, there was a lot of monetary injection to support the economy, which is what you see in this picture when the red line spiked up to 12% year-on-year basis, but that's anomalous. By and large, Singapore has managed to maintain stable monetary growth despite that extremely large inflow that has been coming in. And in fact, by pursuing a rather prudent policy of exchange rate appreciation, inflation has been somewhat managed. Not like 2022, when we had 10% inflation on import prices, on energy prices from food. All those things were really, really causing a lot of consternation among the average Singaporeans. Those things have come down substantially, and MAS in its recent policy meetings actually showed that if it had not maintained the sharply appreciating policy vis-a-vis the Sing dollar, inflation would have been another several hundred basis points higher. So kudos to the authorities to manage that extremely large amount of inflows that's coming in and still allowing monetary stability to a large extent. So now, what does it all add up to? Now, I've spent a lot of time in this presentation talking about the US yield curve and its steepening, and that's a remarkable sight, right? When you look at the left panel on this chart, the red dotted line and the red solid line are where US yields were at the end of last year and now where they are now. So we've seen a substantial movement of the yield curve. 10-year was hovering around 4%, now it's hovering around 4.5 plus, and the short end has not gone anywhere. Similarly, Singapore, at the end of last year, always operates well inside the US curve. The 10-year was hovering around 2.5%. That's now gone to 3% plus. So yield curve has shifted up in sympathy with what's happening in the United States, but that hasn't mean that we have seen major interest rate going up either. So when you see the Fed funds rate, that's going up a lot. Sing dollar rates followed that for a while. till late 2022, early 2023. Since then, MAS has ensured not just the fact that exchange rate is appreciating, but also the fact that interest rates are stable. So that's a lot of monetary policy juggling, trying to keep inflation stable, interest rates stable, and the currency on an upward trend and monetary aggregate stable. Most central banks will sort of give up on one or the other. In this particular case, seems like, so far at least, it's been fairly well managed. So these are involved discussions. There's a lot more detail in Hunting's publication. Do look them up. And if you have any questions, you can ask them. This is your chance. All right. Let's me take out my phone, which will help me connect to our Pigeonhole. As I said earlier, lots and lots of questions. So 16 questions. I'm going to take the first one and put it on the screen. Let's see. Do you see big risks in emerging markets given high interest rates in the US, which is sucking liquidity out of non-US assets? Now, emerging markets are not exactly the darling of global investor community. We've seen a lot of capital being withdrawn from emerging market economies in the last few years. One exception would be India. Even India saw huge withdrawal in 2022, but in 23 and 24 so far, it's seeing a lot of money going in. But for the rest of the world, it is very hard to compete with 5% interest rate in US dollar terms and a US stock market, which you saw earlier, has been delivering very strong returns month after month. Some of the US companies are now the darling of global investors, right? From NVIDIA to Microsoft to Apple and Google, they're all on the forefront of the newest technology. When you have that much exuberance in the US stock market, and when you have that attractive a yield in the US fixed income market, it is very hard for emerging markets to compete with that. So yeah, I think the risk is that, the US keeps on, sort of sucking out liquidity from non-US assets, and I really don't see that ending anytime soon. One exception I would make is China, because China in the last few months have shown telltale signs of bottoming out. And even when I was in the US 2 weeks ago, I heard from some US money managers, they find some of the valuations in China compelling. So do expect to see some deployment of capital toward China in the second half of the year, especially if we have some blockbuster IPOs. Companies like Shein and perhaps even Ant Financial, if they start coming into the pipeline, that there will be some listing in Hong Kong or elsewhere in China, we will see some significant pickup in flows in that area. All right, let's take one more question. Oh, this could be a controversial one. The Wall Street Journal reported that Trump advisors are drafting plans to diminish or abolish the Fed's independence. Will this become an issue for bond yields and the USD at the November elections? I don't think in the scenario of Trump getting elected that they would try to abolish the Fed. That's just not within the realms of possibility in my view. I do think there are some people who are in Trump's orbit who can be very anti-Fed, but I don't think that will necessarily translate into legislative effort. It's just not going to fly. US has institutional depth independent of who is the president of the United States. You can be sure about that. But there will be issues related to the relationship between the executive and the monetary authority branch of the United States. We saw this play out in the last few years of the Trump administration. Before the pandemic hit, when the US economy, in my view, was doing just fine, the browbeating by Trump did cause the Fed to at some point start cutting interest rates. They cut interest rates by 75 basis points back in 2018, 2019. So would Trump again demand that the Fed cut interest rates? Absolutely. I don't think we need to second guess that. But would he try to take the Fed's independence away? I don't think so. What he might try to do is, fire Chair Powell or try to put, if there are any vacancies, put some of his, sort of yes man, if you will, into the Federal Reserve. None of those things will be good for the markets. It will cause market volatility, no question about it. But I think if we want to worry about the dollar and the US Treasury in the context of a possible Trump victory, we should worry about it through the lens of the fiscal, not of the monetary. That's where the risk is, that there will be even greater tax cut impetus in 2025 and beyond, and very little desire to cut spending, which would really blow up the US deficit, and that would lead to substantial consternation in the fixed income market. No question about that. All right. Okay, question on emerging market debt coming up. I see emerging market local currency debt as providing good value. We can get a double discount, if you will. This includes higher yield to maturity and also a possible currency appreciation. Agree, disagree, why? Well, the possible currency appreciation part, I would have agreed 4 months ago, and I would have been very enthusiastic and long Indonesian bonds and maybe Chinese government bonds and so on. But on the currency side, that hasn't worked out very well, has it? So I think this issue will come back into my consciousness in a couple of months' time if we see material weakness in the US economy. Around that, we start pricing in rate cuts, around which the dollar tops and emerging markets could rally. Then I would very enthusiastically and very quickly start looking for value in emerging market local currency debt. Until then, I'm going to be a bit defensive because that trade hasn't worked out so far in the first 4 months of this year. And looking at the data, it will not work in the next month or so. We'll have to wait a little longer. Wait till June. That would be my advice, at least June. Let's move on to the next question. I'm cognizant of time. We're running out. Okay, now this is a pretty serious question. In your opinion, what is the most severe global imbalance? Is there an alpha trade we can take advantage? Well, the most severe global imbalance right now is the US dollar, in my view. Now, you could argue that it is sustainable, but you could not argue very vociferously that it is not an imbalance. The sort of appreciation that we have seen with the US dollar and the kind of correction that we have seen its counterparties in Korea and Japan and elsewhere, I think there's reasonable argument to be made that there is a fundamental misalignment in global currency markets. We will see this correct. Nothing lasts forever, but it doesn't mean that makes us go short the dollar all out tomorrow. Just like the earlier question, we would have to wait for a little more data on the leading indicator side to suggest that the Fed will be in a position to cut rates, and then all of these trade will start playing. But we're in a bit of a, what I would say, suspended animation right now. We can't really move on that direction yet because we could have moved very, very logically and persuasively in that direction 2 months ago, and we would have lost a lot of money as a result. So yes, there is an imbalance, but that doesn't mean it gets sorted out tomorrow. I think I'm going to take one more question, and then we will wrap this up. It's about Asian central banks. How much longer can Asian central banks afford to keep borrowing costs high without sacrificing economic growth? Unfortunately, they have no option. What have we seen in the last few months? Central Bank of Indonesia, which I'm sure has no desire to hike interest rates, has been compelled to hike interest rates given the weakness of its currency and some worries about its bond market. I don't think there is necessarily a state of crisis as far as growth is concerned. Globally, trade is not doing very poorly. Demand is pretty decent, whether it is in the US or China. Things are not particularly alarming. So emerging market economies that grow through exports of commodities, grow through exports of goods, I think they're okay. Of course, there are pockets in emerging market and developing markets where there is some crisis going on. Sri Lanka, Pakistan come to mind. Those countries certainly could do with some easing of interest rates, some relief. But I think those countries also have huge amount of macro and structural imbalances that need to be sorted out, which needs to progress with or without US interest rates cuts. It's not a happy picture. It's, I think, difficult for every country in the world to deal with this higher for longer narrative. And particularly Asian central banks, I'm sure, have no desire to keep rates high for a very long time, especially as I just showed in the very beginning when we're looking at inflation momentum charts. Inflation is not a big concern in Asia. But high interest rates in the US is a drag. You can't start cutting rates. You will see capital outflow. You will see your currency weaken. You don't want to do that. So we are in that phase that the overarching narrative around higher for longer is that policy adjustment, whether a country needs it or desires it, it all gets suspended for a little longer. Maybe a month from now when I come back to you, we can talk a little more convincingly about possibilities of rate cut. But for the time being, stay where you are. Don't change your trades so much. So we're going to stop right there. And thanks very much to all our listeners and viewers. And thanks to our fantastic comms team and tech team, which made this virtual reality presentation possible. I hope the video, audio, animation, everything worked out very well. We'll see you again in June. Until then, everybody, stay safe, stay healthy. And we're signing off from here. Bye-bye.